Welcome to Capital Budgeting Techniques, second part. In this part, we are going to focus on how to calculate, interpret, and evaluate another sophisticated method, which is called internal rate of return, IRR. We'll also look at the net present value and IRR in terms of NPV profile to compare NPV and IRR techniques. Profiles is basically an interpretation and we'll look into this. Finally, we're going to discuss the NPV and IRR in terms of conflicting rankings and the theoretical and practical strengths of each approach. Let's begin. The internal rate of return is the discount rate that equates the NPV of an investment opportunity with $0. So basically, it is the rate of return that the firm will earn if it invests in project and receives the given cash flows. So it basically equates the cash inflow and cash outflows. In other words, we can say that it is the cash inflow, which is at time t0, equals the cash outflow, which is t is equal to 1 up to n, 1 plus, we call this r t, and this r is basically called IRR, internal rate of return. So we are trying to compute this r by equating the initial investment with the discounted cash flows that we will receive from the project. So R is the balancing internal rate of return, or R is the balancing number, the number that actually equates outflows with inflows. Now, the decision criteria of internal rate of return is that if IRR is greater than the cost of capital, which is normally represented as WACC, accept the project. If it is less than cost of capital, reject the project. So these criteria guarantee that the firm will earn at least its required return, which is, so WACC is basically the required return. Such an outcome should increase the market value of the firm and therefore the wealth of its owners. So consistent with NPV, positive valuation is required, and this is transformed by IRR greater than the WACC. If IRR is less than WACC, we reject the project, and we believe that it will reduce the value of the firm. So let's look at the IRR in terms of timelines. So this is project A and project B, the BEC's capital expenditure alternatives. Now in the first project A, the BEC invests $42,000. That is an outflow from the pockets of the BEC, and they will receive, or the project will earn, $14,000 over the next 5 years. This project, these 14,000, when discounted to present, it will have to be $42,000 so that we have equals to 0 NPV. Now, in order to bring it to 42,000, we need an IRR. Now, what is the IRR at which this will become 42,000? And that is 19.9%. How do we arrive at 19.9%? The calculator does the job for you very quickly. Also, the Excel function IRR can also do a great job for you to identify the rate at which the outflows equals inflows. So the cash outflow equals the cash inflow. And what is the rate at which cash outflow equals inflow? Or the more famous definition is, what is the IRR? The IRR is the rate at which NPV equals to $0. So for project B, we can see that we can have the same 0 NPV. That is, we need 45,000, which was our initial investment. If we can earn that much, we'll have 0 NPV. Now, what is the rate? And the rate turns out to be 21.7. And here we have to calculate IRR for each one of them. And in calculator, we can add it into cash flows and it can be readily calculated. So in this case, comparing the IRRs of project A and B to BEC's 10% of cost of capital, we can see that both projects are acceptable because both are greater than 10%. And if this is the case, what should we do? Comparing the two project IRRs, we would prefer project B over project A because IRR of 21.7 is greater than 19.97. So first part of the decision criteria was which one is greater than WACC. Since both qualify, we go to the next stage where we rank the project by seeing which project gives us higher internal rate of return, and that is the project B. And you can see in the calculator, we can replicated the same functions that we use for NPV, only that we do not calculate NPV. We add the interest, and we do not add the interest as well. We actually compute the interest. This is for computing. If we compute the I, here also we compute the I, we will get the IRR, which is here in this case it will be 19.9%, and in this case it will be 21.7%. You can use both methods and also manually. Plus you can use Excel, and Excel, the great friend, can help us in calculating IRR, and you can see the IRR can be calculated with a function. So in calculating the IRR, some of the interesting things are that in the last example, project B, which has an IRR of 21.7, is preferable to project A, while in the last session we established that A is better than B in terms of NPV approach. Now this is in conflict, and this conflict is not very unusual in these type of projects, especially when we are looking at competing projects or mutually exclusive projects. Now there is no guarantee that NPV IRR will rank project in the same order. However, both methods should reach the same conclusion about acceptability or non-acceptability of projects. So NPV is in dollar, IRR is in percentage, NPV is in dollar amount based on WACC or weighted average cost of capital, while IRR is based on the internal rate of return. So net present value profile helps us to go deeper into the results when, especially the situation where NPV and IRR are in conflict. It helps us to look at in a much more detail. So to prepare NPV profiles, we need to develop a number of discount rate NPV coordinates and then graph them. This is pretty straightforward, and you can see that at 0%, we will have project A. So where there is no discount rate, in absence of any discount rate, what project A will yield and what project B will yield. So you can, if you remember, so we have $14,000 for project A for 5 years. If you multiply and then you subtract it from the initial investment, which is $42,000, you will have $28,000 for project A. Similarly, if you add all the cash flows, which is 28,000, and then I think 12,000, and then the 10,000 multiplied by 3 because it was for 3 years, and then subtract it the 45,000, the inflows, that will the initial investment, you will get the 25,000. Because why we do this? Because there is 0% discount, there is no time value of money applied. So what we invest and how much we get is straightforward. However, when we use 10% discount rate, which is the cost of capital, or 10% discount rate, the project A will yield 11,000 while project B will yield 10,924, and you can check it by using calculator. At 19.9%, you can see the project A will have a 0 net present value, and 21.7, project B will have 0 NPV. So this is the IRRs at which the NPV is equals to 0, and for project B it's 21.7 is the IRR at which the NPV equals to 0. Now let's look at it in graphical form. You can see that on y-axis we have NPV, and on x-axis we have the discount rate. Now there's some of the things that we have to look at carefully. So when we plot these, we see that the project A, which is represented with a red line, is cross or it can come across with the project B, which is represented the blue line, at 10.7%. So at 10.7%, neither of the project is showing us any ranking in terms of NPV, or in terms of NPV, or in terms of IRR. But if you go forward, you see that this is the point at which NPV equals to 0. So discount rate at 19.9%, where the discount rate the IRR is 19.9%, the NPV equals to 0. On this line, it's all NPV equals to $0. Now for B, it's a little bit higher, which is 21.7%. So if the line is going in this direction, obviously the NPV is the IRR is increasing, and the NPV will fall to 0%. It is also possible to have a project with multiple IRRs. In that case, normally we use modified internal rate of return, which is not right now a challenge in question, and we left it for the higher sessions. So let's look at the conflict rankings in a bit more detail. They arise because of the differences in the magnitude and timings of cash flows. One of the underlying cause is the reinvestment of intermediate cash inflows. Now, we understand that under time value of money, the interest on interest is reinvested. So this reinvestment assumption is embedded in time value of money, and so far we have not considered it, and let's talk about it a little bit more. So the NPV assumes that intermediate cash flows are reinvested at weighted average cost of capital, or cost of capital of the firm, while IRR assumes that the cash flows are reinvested at internal rate of return. And since we know that for any IRR, for any project to be approved under IRR, it has to be greater than the WACC. Sorry, it has to be greater than the WACC. So if it's greater than WACC, only then it will make sense. This means that IRR will create more value compared to NPV in terms of reinvestment. Let's look at this through an example. A project required $170,000 initial investment, is expected to provide cash flows of $52,000, $78,000, and $100,000. The NPV of the project is 10%. So let's at 10%. So this is the weighted average cost of capital. Let's look at or plot this on the timeline. On timeline, we have 0, 1, 2, and 3. So we have 170, then we have 52,000, 78,000, and $100,000. Now the NPV, if we bring all these at 10% cost of capital, then it will be equals to 186, 86702, and this will be total equals to what is given is $16,867. Now this is a positive NPV value. Now if you have to if you compare the IRR, compute the IRR, then it will be equals to 15%. So NPV is positive, IRR is higher than the 10% cost of capital, so the project has to be approved. Now look at it from the reinvestment perspective. I'll use the blue color here. So reinvestment can be done at if you're considering NPV, then it will be at WACC, which is at 10%. Or the other one is if we are considering IRR, then the reinvestment is at IRR, which is at 15%. This is 10% and 15%. And let's draw the quick timeline, and you can see this timeline for NPV would be 0, 1, 2, 3, and we will not, as soon as we receive the $52,000, we're going to reinvest it and this time our threshold is 10% for NPV, and this will be compounded till third year here as a single amount, and this will give us, so this is n is equal to 2, n is equal to 1, and n is equal to 0, and this will give us a total amount of 248 $720. If we use IRR as the cost and compound all the uh, cash flows, 0, 1, 2, 3, this will be 52,000 that we'll receive 1 year, and we'll immediately reinvest it, 78,000, and then 100,000. And if we take it to the future and compound it at 15%, we will get an amount which is equal to, so I'll write it here to have more space, 258,470. You can see that 248,720 is less than 258. It's because IRR is higher than the WACC, hence it creates more value. And this is because of the reinvestment of the cash flows at a higher IRR, at a IRR rather than at WACC. And IRR is higher than the WACC, hence it will be, then dollar amount will be higher than the NPV method. This is shown in the tabular form as well, and you can see that the for the 2 years, if you compound it, then you will get at 10% you will get 62, at 15% you will get 68, and for 78,000 cash flow you will see the same. 100,000, since there is no t is equal to 0, there is no time value of money applied to it, so this is 100,000 the same. The total, when you add it, you get 248, and if you subtract it, you get NPV for this project, which is 67 at 10%, while IRR is 15% for this project. Now we can see that this was the total amount received at the third year after reinvesting the amount at either WACC, which is 10%, or IRR, which is 15%. Now for this, we'll have a different IRR, that is 13.5, because if you discount 248,720, which is, if you use it as a future value and discount it as a single amount at 10%, you will receive 16,867, and if you compute the IRR for this, it will be 13.5%. so this is, the IRR is compared to 15% is less, hence the second project actually creates more value compared to the first project. Now, another reason why the IRR and NPV methods may provide different ranking for investment options has to do with differences in timings of cash flow. We saw that in terms of reinvestment as well. When much of the project's cash flow arrive early in its life, the project NPV will not particularly sensitive to the discount rate. However, the NPV of project with cash flow that arrive later will fluctuate more as the discount rate changes. And these differences in the timing of cash flow between the two projects does not affect the ranking provided by the IRR method, because IRR also take into account the timing of cash flows. Now, magnitude of initial investment is also very important. The scale problems occurs when two projects are very different in terms of how much money is required to invest in each project. So IRR will give answer in percentage as a rate of return, and hence it will not differentiate between the magnitude, while NPV gives the amount in dollar amounts, and hence it will give you the proper dollar amounts earned on a project. So depending on the size of the project as well. The IRR approach may favor small projects with high returns, while NPV approach favors the investment that makes the investor the most money. So magnitude matters in NPV compared to IRR. On a purely theoretical basis, NPV is better approach because NPV measures how much wealth a project creates. Now this is very important for many investors, that in dollar amounts how much investor has been created or destroys if the NPV is negative. And certain mathematical properties may cause a project to have multiple IRRs. So if it's non-normal, cash flows, which means the sign changes multiple times during the project. Sometimes inflows, outflows. There are multiple outflows, multiple inflows in the same project. Then project can have multiple IRRs. So this is not the case with NPV. Hence, NPV stays as a much better way of representing the wealth created by a project compared to an IRR. However, it is also surprising that NPV and IRR are almost similar when it comes to usage. The managers use IRR as much as NPV, and it's maybe because IRR is more of a measure in terms of rate of returns than compared to dollar amounts. Now, non-financial considerations should also be part of the project selection. You can see that for most companies, ethical considerations are primarily concerned with the reduction of potential risk associated with project. And another way to incorporate non-financial consideration into capital project evaluation is to consider the likely effect of decision on non-shareholder parties or stakeholders, employees, customers, local community, and suppliers. Well, you can answer this question, but for example, oil drill creates a massive mess around in the area, and the reversal of the area to the pre-drilling time is hugely affected, or it's very expensive. Hence, that could be added to the project selection, because maybe later on the laws will require the area to be reinstated in the same position as it was prior to the drilling, and hence this will be a social responsibility cost that will be incurred and has to be made part of the project selection. Now, what we have learned in this chapter, we have looked at the calculation, interpretation, and evaluation of internal rate of return. We've also looked at the profile, NPV profile, to compare NPV and IRR techniques. We have also looked at and discussed the NPV IRR in terms of conflicting ranking, especially with respect to reinvestment of cash flows, and the theoretical and practical strengths of each approach. This is it for now. Thank you very much.